All right. Good morning. It's 8:04, a little bit late. My name is Vince Lanci, and this is the Gold Fix, a very special uh, edition. Somebody just typed in fake news in the Q&A. Mike Strong and Mike. I haven't said anything yet. Uh, Nothing's fake. Well, it's all fake anyway. Anyway, we're on the air. I'd like to welcome two new subscribers who shall remain called uh, buy the double bottom. No, that's too complex. Short the NASDAQ. That's one subscriber. And the second subscriber is uh, buying Apple soon. I hope we didn't buy it yesterday. But anyway, welcome to those two new subscribers, and welcome to everyone else. There's a couple things I want to get through today. It occurs to me that a lot of people may not know my bona fides, and Larry's are pretty obvious. You can look me up and find out more about me. But I wanted to give you some. I'm not a very good self promoter. Gold is fake news. It's actually fake. Gold does not move. Exactly. It's a store of value. Oh, gold gold will move after. I'm just commenting on a subscriber, John Hassinger. Yeah, gold does not move, and when it does, it'll be too late. And when gold does go to infinity, you're not going to walk into a deli and ask for a ham and cheese on rye with a gold coin. You're probably going to have a gun. So, um, to John's point, I'd rather have a bow and arrow than an ounce of gold if I really need it. That said, uh, it doesn't rust, so it's easier to own than Cadillacs if you're hedging dollar risk. Okay, guys, let's talk about markets, including gold. But I do want to focus on two things. Are you talking about crude? Really, John? That's so rude. All right, so we're called for a move as the Fed follies begin today. Yesterday, here's a 15-minute chart. You can look at that. All right, you could see that the market did nothing, as John teased. If you want to understand what happened last night, including the Apple tariff and how that affected markets, after playing up the possibility of a deal with President Xi this weekend, Trump told the Wall Street Journal that he expects to go forward. We all know about this, right? He's going to raise the tariffs. He's back to being the bad cop again, and raising tariffs on iPhones too, possibly. I have no idea how that's going to work. All right, so this morning, you can read this. The global capital markets have taken the U.S. latest tariff in stride. Love the word antipodean. That's Mark Chandler. I want to get to actionable levels today. We have what appears to be a signal on our radar, but I want to say that it is not, because even though the Bollinger Bands show the type of tightness I want, if you look at the very bottom, you'll see that, I didn't highlight the box there, but if you look at the bottom, the 5-day is supposed to be 50% of the 20-day, and it's not. Should have occurred before that. So I think we're going to have more tightening on the Bollinger Bands. The point is, I think we're going to get a better risk reward. If the market does rally or drop $50 or rally $50, this system would miss that. It sets up for good risk reward, and the risk reward's not there according to volatility terms. Doesn't mean we wouldn't dip our toe in on a break of either side. And the actual levels are on the Bollinger Bands themselves. All right, on the weekly, if you can ignore all the trend lines there for a second, I used the wrong chart. You have what is now a classic setup for a trade. So the Bollinger Bands are tight enough, okay? And at the rectangle at the bottom, the 5-day historical volatility is less than 50% of the 20-day historical volatility. It has to precede it as it did. Bollinger Bands tighten. Looks like we'll have a tightening for the rest of the week, and then you would look for a violation of either side for a trend. You get two bites of the apple and reverse. So we have gold is on the radar for the hourly. Perhaps maybe 3 hours into today we'll get a signal, which makes sense considering all the Fed stuff going on. And it's on the radar for the weekly for sometime next week. Going to the technicals. if we break, so if you want to look at the high low range today, get long above 1223, and you would get short below 1218 and a half and cover on a reversal above. Note that that is a $5 range, and the average daily range is between $6 and $7. So we're not looking at big breakouts here on his own technicals. I look at Michael's technicals right now and I say these are probably chop type of ranges, meaning we'll go above 1223 and a half, and you'll get stopped out if you're long, and then back below, and vice versa. But the numbers are good. Okay, central banks and daily data, consumer confidence and housing price reports are due out today. Likely these will be overshadowed in the markets by Fed watchers. I wrote that all by myself. As stated before here, Powell, Clarion, and Williams are united in their rhetoric. That rhetoric is math-based. When strong economic numbers come out, Powell and company say, I told you so. The only cover, and this is spelling aside, the only cover Powell has that cannot be ignored. He can ignore every other color and spit everything else. Like, I'm worried about this, so I'm focused on that, even if the economy is slowing down. But he cannot ignore low oil prices. So if he wants to back off, and I think he's not backing off well into 2019, he could use oil as his cover. Just a comment, an opinion. I think the stock market does his job for him. The market rallies, and he doesn't have to worry. I guess he can raise rates. So the market is kind of chopping itself up on the back of its anticipation of what he's going to do. We do not think Powell back off, as this is also part and parcel of the global economic warfare being waged to lock in trade partners and delay the U.S. dollar dethroning as reserve currency. Long story short, QT has another effect. The other effect is it forces you to pick a trade partner. Either you adopt and you get married as opposed to engage to the dollar, or you are pushed to the point of crisis, not crisis, but the issue is forced. You have to cut bait. So if you're Russia and China and you're thinking about getting out of the dollar, or you are getting out of the dollar, this would probably only accelerate uh, uh, your actions. If you're more tied to the U.S. dollar or the United States via debt, and an inability to get that debt covered by, say, Russia or China, and or you do trade with us, like in the whole NAFTA package, you're more apt to combine with us. Now, not to be Orwellian about it, but I think we're looking at two trade blocks forming: North America and Asia, and Europe is in the middle somewhere. And I think Russia pushes Asia. Russia pushes Europe. Like as of yesterday, with the Russian tension, Russia pushes Europe towards the dollar. But that's pretty much that. In other money, you can see the dollar is mixed, as noted. We have a section on miners today. Note this: if you're trading or buying or investing mining shares, they're now trading at a 15.4% discount to net asset value at forward curve prices. Versus 11.2% discount 1 week ago. Basically, you're looking at forward curve prices on gold, and there's a correlation between that and mining shares. And the difference between those two has to do with management, has to do with hedging, et cetera, et cetera. By no means am I saying that that's a buy, but I'm saying that you are seeing more of a discount. Mining shares were down on average 5.4% last week. Best performing group was uranium, yippee, down 1.7%, followed by copper, et cetera, et cetera. There's a snippet of the report. The full report will be later. All right. Okay. I am not a person who self-markets very well. By the way, that's an RBC report. Hat tip to George Giro, and hat tip to the model for putting these spaces in. All right. A quick I don't want to make this an autobiography, but I want to give you a little bit of insight without getting into a CV that gives you an idea of who I am to talk about gold. I think this is relevant, as everyone should get an idea of who they are listening to when they're getting their advice, or not necessarily advice, but observations. All right. I am no one of consequence. There's two favorite phrases of mine from The Princess Bride. I am no one of consequence. When He's asked, one of the main characters asked by someone, his name is John Neese, and later on he says, I'm no one to be trifled with. I am no one of consequence. But I would like to show you this quickly, uh, starting at the bottom. Okay. Starting at In 2015, I was working with a hedge fund, waiting for an allocation, and the hedge fund blew up. Uh, in 2014, the CME granted me market maker status uh, for CSO options. Having done that already in gold options, the NASDAQ offered me market maker status as well. These are things I actually turned down from another firm because I did not want to trade options as a market maker anymore. I wanted to go more directionally. It's not to say it's not my first love. All right. In 2013, I was the number 3 liquidity provider in CSOs. By 2014, I returned to the fund that I worked with for a CSO market maker plan in 2012. In 2004 through 2008, I traded as a gold market maker on the CME electronically. I put on an EOO trade. These are options on oil, actual natural gas. You can read the rest there. I've been basically in every crisis, precious metals wise, since 1994 or earlier. 94, fibro exercise options. Uh, I traded through that profitably. Sumitomo copper collapse, traded through that profitably. Silver squeezed profitably. Ashanti gold default 99 profitable. Natural gas squeeze in 2000, yes. 9/11, yes. It was 5 different portfolios. So there's a snapshot of who I am and my experience. I've taken delivery of silver. I've managed $50 million for a multi-billion-dollar hedge fund, and I don't want to trade options anymore as a market maker. I will do that again someday when I think the edge is there. But that's a little bit about myself and my background with regards to precious metals, long-term capital. I've been involved in that too. All right. Okay. I want to do a quick plug for our show today at 1 o'clock with Tom McEntee. In 6 months, anyone who tunes into the option show with Tom and myself will know more about options than 99% of the world. How you would test that, I don't know, but I'm pretty sure of that. The sheet below would be easily read if you wish to learn how. This is not something we're talking about today, but this was my portfolio in 2012 in gold options. If you read to the left, that's the market going down. If you read to the right, that's the market going up. But these are advanced Greeks. We're not going to talk about that today. But the point is, you will be able to if you listen to us religiously, starting with the basics, working through all this in 6 months. You'll know more than most people out there. Let's look at the live markets right now because Clarita speaks today before the equity markets open. So why don't we take a look at that? No. All right, so the dollar's a little firmer, gold's a little firmer, silver seems to be leading the way. I don't see anything special about silver on the radar. Uh, the Aussie dollar, we had an article about that. I actually want to put that up because I know there's people out there trading the Aussie dollar. We put a nice little article about the Aussie, about the Fed today. There's the overnight recap. Okay, if you want to catch up on what's happened going into today's U.S. activity, this is a nice little post by John Hardy of Saxo Bank. There was a pump and dump in the Aussie dollar last night on the back of Chinese Foreign Minister spokesman words being overinterpreted. This is a nice report on currencies in general, and it talks about, excuse me, pardon me. The Fed is likely highly reactive to Clarita's incoming data and the latest sense of the U.S.-China trade relationship. It doesn't mean much to me. A Fed guidance change to the dovish side is most likely to coincide with rather alarming prospects for the U.S. economy. So basically, there's not going to be any change. I would lean more towards a 2001 setup, and I have in here a little British pound chart for Larry, especially. Here we are below 130 for 3 days in a row. I guess the new range is 128 to 130. We do have a double bottom. Technicians looking at that. Brexit is not something to be laughed at, as Europe, I think, is the Carolingian Empire all over again. While we have a second, since I got through this quickly, uh, uh, here's a paper on options that, again, we're not talking about. This is forecasting crude oil and natural gas volatility, a paper co-written by UConn, myself, and some Chinese students. Join Tom and myself today for our first option webinar. John Cormier. People who did not sign up for the webinar on options include Myron Scholes. Uh, he lost money trading options. John Merriweather lost money trading options, and John Cormier. So these are famous people that did not take the class that Tom and I are offering. Uh, uh, and if you're interested at all in this paper, it is a cure for insomnia. But this is a paper that basically describes energy volatility in the really high level aspects. We were looking for an ARB in the VIX, the oil VIX, and there really wasn't one. Looking at, say, the kurtosis and skew involved in it. But we did notice that we tried to create an index for natural gas volatility. The seasonality makes it very hard. Again, this is really not something to read unless you're really a geek on this type of thing. And I can't even read half of it. You know, I come up with an idea and they spit out a lot of work. I think the thing that's worth reading, theory foundation of the OVIX, and this is relevant. I bring this up because of what's happened in oil. The put skew would make volatility, implied volatility, scream as we go lower. That's not sustainable in the short term. The problem with that is if you start selling the skew as a market maker, the market ends up moving violently higher, and vol comes in, but it moves away from your short, and you get hammered. So it's probably a good time for 1x2s if you're a trader like Tom, and you can stomach a possible margin call because you probably collect premium now. The other aspect of this that I think is, well, we made a couple predictions in here. This is natural gas volatility. We're talking about the actual uh, correlation between historical and implied volatility. A couple conclusions and option moneyness. This is how we describe it so people could read skew versus non-skewed options as a predictor of stochastic processes, which basically means if you're running a put skew market and the market drops, vol should expand. With regard to the stock market, I want to bring that up right now because put call ratios are at lows, meaning for the difference in volatility between calls and puts is at historical lows, not all time, but historical lows. And some people are looking at that as bearish because people are not hedging, or bearish because people are buying more calls because they're putting less money into stocks. Those are 50% possible. And then the other people looking at it as bullish would be people saying, well, there's not a lot of hedges being bought because a lot of money is in cash right now. So if you look at that, and you can verify that, I haven't verified it, but I do believe a lot of money is in cash right now. And that makes sense as people are waiting for allocations. The trade, if you're a long options trader, is to buy a hedged call spread if you think you don't know which way we're going to go. But to interpret the put call ratio, first of all, VIX as a fear gauge is great for trading. Skew as a fear gauge is worse. And my dog says it's time to go. So it's 8:23. Have a great day, everyone. And I'll talk to you later.